Good evening, ladies and gentlemen. Welcome to the Stock Market Brief Show. Today we're going to keep it quick and to the point. We're looking at a chart of the S&P 500, the SPY. And I noticed something very interesting these last couple of trading days. At about 1 p.m. Eastern Standard Time, you can see that there is quite a bit of selling that takes place during those times. Perhaps that is when the CTAs kick in and you get some algorithmic selling roughly around the same time every single day. But I wanted to also call out, more importantly, a couple of things that I noticed here. One being that we're below a declining 5-day moving average, and we're really just consolidating here. So every time the sellers step in, we got a pretty long move to the downside here, a little bit less aggressive here, a little bit less aggressive, a little bit lesser aggressive right here. And as you can see, while that's taking place, price action is getting tighter and tighter as we move into an impactful week. So much so that I can show you, not only do we have an impactful week for like seasonality, right, where you typically get some pretty big moves towards the month end, but that could be because we also have a lot of macro data, such like we have JOLTS, okay, we have the Fed interest rate decision. We also have, I believe, the Bank of Japan, the Bank of England, you know, to name a few more. Over here, we got ISM, and then to sprinkle more on top of it, we got non-farm payrolls, jobs numbers on Friday. But that's, you know, one part of it. Then we have earnings, and we have tomorrow after the close AMD, Microsoft, and then Thursday we have after the close Amazon, Apple, to name a few of the larger market cap names. And while this is taking place, there are some very, very large expected moves building. For example, the S&P 500 has a weekly expected move. The upper level's at 555, the lower level's at, I'm going to round up to 534, okay? Which that equals roughly $10.50 for the expected move on the week, which is one of the largest we've seen in a long time. The SPX has a $104 expected move for the weekend. With all this data coming out, I'd expect us to tag some part of that. You can see, if we look at the monthly expected move, the lower one and the upper one, we've came all the way up to the upper and got outside of it of the expected move for the month. And now, you know, month's almost over, and where are we? We're right back to where we closed last month. We're consolidating right on that level. We're slightly up month to date, despite seeing all of this volatility. And yes, this does look like a bearish setup here, but I want to call out a couple of things, a couple of levels to pay attention to. The level that I want you to pay attention to is if we start breaking right here, roughly at about 547.50, because this could still be a potential double bottom or a bear flag, right? So you'd want to see price action clear that level to maybe give us some insight of a higher high and then a continued set of higher lows. So that's what the SPY would look like. If we take a look at the Qs, it's a pretty similar situation here. Looks like a big, gigantic bear flag in the making. We have matching highs right there, but overall lower highs, lower declining 5-day moving average, and price action's getting very tight going into some wicked earnings and Fed announcements and just macro data overall. So I think the best way to handle this is twofold, right? One, if you want to take a stab short, it makes sense to follow the trend to the downside. Two, if you're looking to go long, you can do it one of two ways. You can go early, but you got to have a stop in place to mitigate risk if you are wrong, because if this expands to the downside, it can be quite aggressive. Or another way is you wait for the break of this line, this neckline over here of a potential double bottom. If it does break, you can see if the 5-day moving average starts to flatten out and turn back up. And then we create a series of higher highs, higher lows, and you can play like such with a stop under here, a stop under here, or stop under here. And that could give you a little bit more confidence in a move higher, because you're going to be playing with a trend potentially changing. But right now, we're below a declining 5-day moving average still, and we remain in negative gamma territory. And as I pointed out before, why is the gamma flip line so important? Because when we're below the gamma flip line, this is where typically volatility increases and liquidity dries up. And we've been in negative gamma territory and positive gamma territory many different times. And what I've been showing people is if I go into the time series of net gamma, you can see from the beginning of May, right, roughly the beginning of May till about mid-July, right? This was all positive gamma territory. It was above that zero line. Then we've been in negative gamma territory. So what does that look like if I show you something like the VIX or VIX futures? If I look at the VIX on the daily time frame and we go back to May, right? May was right over, the start of May was right here. you can see volatility was going down. It wasn't up until what? Mid-July, right? July 16th or 17th or whatever it was, where we started volatility increasing. And that's when we went into negative gamma territory. So if you're wondering, oh, why is that line? Does it even matter? Yes, it absolutely matters, because this is giving us insight to when conditions change. And that really does affect people that do swing trading, because when you're in negative gamma territory, when you're below a declining 5-day moving average in these big index products, you get a lot more whipsaws, a lot more fake outs. Your support and resistance lines, they don't mean nearly as much as they do in a lower volatile environment, because it becomes more, you have to look at zones more frequently. And as you can see on the S&P 500 chart here on the 65-minute time frame, price is roughly at around this prior zone that we've mapped out, about 5450 to 5460, that level. I would still say watch that 5400. That is an important put wall. You can see here, if we go into net gamma, you can see that 5400 level right over here, and you can see even traders reaching out a little bit further down at 5300, but 5400 would be that level of support to kind of keep an eye on for the potential downside if we are going to continue to go down into that range. I wanted to check one thing really quick here, and that's the VVIX. And you can see last time we talked about the VVIX was when it came up to this 110, and you can see volatility is slightly coming in, while the VIX is still holding rather strong up here, but it is coming off slightly overall as we're getting closer to that flip line, but not yet quite crossing through it. So come tomorrow morning, we'll see where this flip line updates. It could be around the same area. Maybe it comes in a little bit. I'm not too sure. But that's all I got for you really on today's market brief. We got a huge open expected move for the week. Our daily expected move for the SPY, the upper level is 548.91. The lower level is 540.61. And then for the Qs, our upper level is 469.32. Our lower level is 458. So we got some large expected moves. We're below a declining 5-day moving average, and we're in negative gamma territory with a bunch of stuff on deck. Be patient, be calm. Don't get too crazy, because that's when crazy things can obviously happen. See you later.